Good afternoon and welcome to our virtual class in your subject BAFM 6102, and this is financial management. In our discussion today, this is about financial statement analysis, and I'm your professor, Susan Maminta from AMA East Rizal branch. Our discussion learning outcomes are: one is to classify the different financial statement analysis. Next is to know the basic techniques in financial statement analysis. And the last one is to discover the different types of ratio analysis. So what is financial statements? Financial statements are records that outline the financial activities of an entity or a business. These are meant to present the financial information of the entity in questions as clearly and concisely as possible. The objective of financial statement is to provide information about the financial position and financial performance and the cash flow of the company. Financial position is the status of the assets, liabilities, and owners, while financial performance is a measure of how well a firm can use assets from its primary mode of business and generate revenues. While cash flow, this is about the outstanding balance of your cash or that are focused on the cash outflow and cash inflow transactions in the company. The elements of financial statement includes the financial position and financial performance. Financial position, this is the balance sheet, and this is the status of the assets, liabilities, and owner's equity. And this financial performance, this is the income statement, and this is the subjective measure of how well a firm can use the assets from its primary mode of business and generate revenues. I have here a complete set of financial statement. One is a statement of financial position, and this is the balance sheet. Income statement, this is the statement of performance, and another one, statement of comprehensive income, which is also the income statement, but the difference that this includes other items that are not presented here. The statement of changes in equity, this is about the capital statement, and the statement of cash flow for the in and out of cash of the business, and the notes. Note is also a part of financial statement, as this gives details on the values or figure presented in the financial position and in the income statement. Financial analysis can be classified on the basis of materials used. And for this type of classification, we have the external analysis and the internal analysis. The external analysis is the type of analysis done by other people or entities that are outside a certain business entity. In short, they are not connected to the company, and these are usually done by investors, creditors, government organizations, and other credit agencies. While the internal analyses are made by people inside the business entity, they are connected to the company. This is usually used to understand operational performance of the entity to help in making their business decisions. Another classification of financial statement analysis is based on methods of operation. And for this type of classification, we have the horizontal analysis and the vertical analysis. For horizontal analysis, we are comparing figures from several years and comparing the amount in each account from the past up to the present. While a vertical analysis is the financial statement that are measured based on the relationship of each item in the financial statement with respect to the amount of certain account. These are the types of financial statement analysis based on the material used. We have the external analysis and the internal, and based on the method of operation, we have the horizontal analysis and the vertical analysis. There are many methods or techniques that are used to analyze the financial statements. We have this index analysis. This is an analysis of percentage financial statements, where all balance sheet and income statement figures are expressed for a base year equal to 100%, and the subsequent financial statement items are expressed as percentage of the values in the base year. Another technique is the common size analysis. Under this common size analysis, the figures reported are converted into percentage to some common base. It is usually considered as vertical analysis. So in the balance sheet, the total assets, the figure is assumed to be 100%, and all other figures are expressed as percentage with respect to the amount of the total assets. So the basic techniques of financial statement analysis are the index analysis and the common size analysis. Another technique that you can use in your analysis is the ratio analysis. This is a mathematical relationship between one number to another number. This is used as an index for evaluating the financial performance of the business. So here are the ratio analysis that we can use in the company or in the analysis of financial statement. And these are liquidity ratio, activity ratio, profitability ratio, and leverage ratio. So this various type of ratio, like the liquidity ratio, this is a financial metrics used to determine a company's ability to pay all its short-term debts obligation. So if the company has the capacity to pay its short-term obligation, then the company is said to be liquid. Opposite of liquid is illiquid. So liquidity means the ability of an entity to meet its short-term financial obligations. This can be, or the result, or this can be calculated in these two manners, or in these two methods. You can use current ratio method, wherein you are dividing the current assets to the current liabilities. While a quick ratio is also a liquidity ratio, that you use the current assets, but you deduct the interest and the prepaid expense from the total current assets. Then the results will be divided with the total current liabilities. Another types of ratio is the activity ratio. This is known as efficiency or turnover ratio. This is used to measure how effective the firm is using its assets. The two specific groups under activity ratio are the receivables turnover ratio and the inventories turnover ratio. To compute the receivables turnover, you use your annual credit sales that is to be divided with your accounts receivable. The average collection period, which is the days in the year, divided by the receivable turnover. So what is the result here will be used under this average collection period. Now, for a payable turnover, you are using the annual credit purchases divided by accounts payable. And the average payment period is the result of your payable turnover. That is the days in the year will be divided by that result of payable turnover. While the inventory turnover is the cost of goods sold divided by inventory, and the asset turnover is equal to the net sales divided by the total assets. Profitability ratio is the ability of business to have more income than expenses. So this relates profits to sales investment. So to compute this profitability ratio, you can have this gross profit margin that is being calculated using the gross profit divided by the net sales. If you want, you can also use net profit margin, and that is calculated by the net profit divided by net sales. While the ROA, that is the return on assets, is being calculated by the net profit after taxes divided by the total assets. Return on equity is calculated with the net profit after taxes divided by total equity. Another ratio is the leverage ratio. This leverage ratio measures the long-term obligations of the business. This helps to understand how the long-term funds are used in the business. Well, and this involves solvency. Solvency concept, that is the ability of an entity to meet its long-term financial obligations. So there are kinds of solvency ratios that we can use, and these are debt to equity ratio that is calculated using total debt divided by total equity. While the debt to total assets ratio is the result of the total debt divided by total assets. And the total capitalization ratio is the result of the total debt divided by total capitalization. Now, I